Good afternoon. Welcome to the TheoTrade afternoon video. I'm Blake Young. Today is July 10th, 2025. Thanks for joining me. We're going to talk today about breakouts and calendars, actually. And we talked about this in the main room today. If you were there, you can see that. If you want to go back and watch the archives, it'll give you some idea of where I'm coming from with these setups. We're going to go more specifically into the breakouts in conjunction with Bollinger Bands and the way I approach a single deviation with these calendar type trades. Now, the breakout of the 52-week high today in the S&P 500 is fine. It's not the trade I'm looking for. I'm looking for these breakouts, the breakouts of the Bollinger Band, and we measure the distance from the dot to this close and say if it does that, I'm going to go up to, and I should test this level about 622. So we'd be looking for a move from 606 to 622, and that took 1, 2, 3, 4, 5, 6, 7 days to beat it or overtake it, and really 8, 9, 10 days that we're at it. And that's usually what we're looking for. We're looking to sell about a week to 2 weeks of price while buying more time in the calendar. Now I'm going to show you some setups that we're seeing in this, but this is giving you a retroactive look at kind of the trades that I'm looking for on these Bollinger Band breakouts. This Bollinger Band methodology is one that I've used quite a bit, and I've used it for years. And we hit this target about 60-65% of the time. So if we can hit the target and we set these up where we're getting 2-to-1, 3-to-1 reward risk ratio on a calendar, and we're hitting it even 50% of the time, touching it 50% of the time, we're going to come out significantly ahead. So let me show you some of the trades that are giving us the setups. I'll show you some that don't work for the calendar, but still could be a Bollinger Band type breakout. In fact, the first one doesn't work from an implied volatility standpoint, but I do want you to see what the pattern looks like. So Dow Chemical is breaking out today. It's certainly fading too, but it's breaking through the Bollinger Band. And so the target, my expectation would be that Dow is going to go up to 33.68. So there's a 10% move in there. And if I were to look at the options from the front week to the back week, the front week that we'd be wanting to sell, about, there we go. You can see the implied volatility is 44%. That's that column there, 44%. And the week I'd want to buy at the same strike, 31, is 51%. So I'd be paying more implied volatility than what I'm getting, and this doesn't work for the calendar, but it still works as a breakout trade, an opportunity to buy calls or buy the stock. There's about a 10% move I'm expecting in Dow, but the implied volatility isn't working out for me. If we look at Deere was breaking out. It's actually faded in the last couple of minutes. But if we can stay above this 521, let me show you what this looks like. And we're going to go from that dot to the close. Now, again, we're not there. We were doing better moments ago. We were actually breaking out. The idea would be to go up to 545. Now, if I look at 545 for a week to 2 weeks, because we want to sell a week to 2 weeks, 545 has an implied volatility of about 24% and extrinsic value or time decay of $1 per week. Okay, if we go out 2 weeks and we look at the implied volatility out 2 weeks for the 545 is roughly the same implied volatility. So we don't have a strong edge in this. It would just be a directional calendar trade looking for that 545. But here's the thing. I don't want to sell out there if it's only giving me 80 cents or $1 of premium. I would like to get more premium and have a higher probability. So we're going to go that delta between 30 and 40. I will go as low as 28 and as high as 42. So if you start with this 29, we're selling 24.44% implied volatility. There's a 532.50. Notice there's no 532.50 out here. So we would need to look at a different strike, and that means either go to 535 or go to 530. Now the 535 means that we have lower likelihood of getting called away, but it also means that our short position will expire worthless. We'd pay that at 535 for 240, and we're going to buy the same 535 down here. And there's a $466 trade in here. Now, if everything works out, the front week expires worthless, we're going to be left with 2 weeks of price. So Deere would have 2 weeks of price left, and if we hit our target, that $4 trade would become worth about $12. So it becomes a 3-to-1 reward risk ratio, roughly, to take a calendar on a $521 stock. And a lot of people aren't going to trade a $521 stock because that would take $52,100 to trade. However, the calendar says you can do a trade that would pay you nearly $800 in this trade if you go up to that target. And it's only going to take $466 or $470, and that's the max you can lose as well. Now, if we do hit the target in that first week and we're at the money, like I said, it should be worth about $12. If it doesn't move, if we paid $460 for it and we're not moving, then it would be the same $535, and even then, the trade makes money. So when we sell higher implied volatility in a front week, collect higher premium, we have faster time decay. That front week expires, and even though we might pay $460, $470, even if it doesn't move, the calendar still leaves us in a flat to profitable position at $535. So Deere is a low cost option compared to trading Deere, which is a very expensive stock. And it allows us to set up that trade where we could take the risk on these highly expensive stocks that normally we'd avoid. Let's take a look at a couple of others really quick. Looking at Chipotle, we don't really have the breakout that I want here, but I'm still going to do a measurement because I've done this enough times. I like what I'm seeing on this move higher. It's not a strong breakout, but we're pushing the volume a little higher. I would be measuring this on a target that would go from about 52.50 up to 56. Now the dot has not flipped. This is not a normal trade, but the implied volatility looks really good for what we're trying to do. This would tell us that we're going to break out and probably go to 61, probably even 62 or higher. But if we look at the 2 weeks versus the 4 weeks instead of the 1 week versus the 3 weeks, you'll notice your implied volatility is 51% here and 39% here. More specifically, if we look at going up to that $59 or $60 strike, the $60 strike is 49% implied volatility. And if you go out 2 weeks, the same strike is 39%. So we're getting 10% extra implied volatility or premium. So if we were to go with that 60, we'd sell the 60 and buy the 60, giving ourselves 2 weeks in between. If we hit our target, one, it's only going to cost us $26 to set up the trade, $23 to $26. We'll say $25. If it costs us $25 to hit our target, and we're selling 2 weeks and own 2 weeks more, if we hit our target on expiration day, then that trade could be worth $265 per contract instead of $25. This is a 10 to 1. Now you may ask, well, what's the probability? Well, the probability is this. If you change this line here, we'll change theta, and we're going to go to probability of touching under options theoretical. Probability of touching. And you can see it's about a 50% chance of touching that number. So if you have a 10 to 1 reward risk ratio that has a 50% chance of hitting your target, you have a lot of flexibility there. And if it goes up and gets close to it and the front week expires, now you have an at the money long call that is worth $253 that you could roll another option into and let this continue to trade. So this is just a very good example of the difference of implied volatility, selling higher implied volatility, collecting more time decay per week than what you're paying for. $1.06 for 2 weeks or $1.31 for 4 weeks. So this ends up being about 35 cents and this is about 50 cents. So we're getting more time decay on the front week than the back week because that implied volatility is so much higher. And the one more we're going to do that'll highlight one other aspect of what I'm doing and why I'm doing it. Johnson & Johnson is breaking out today. Johnson & Johnson has a target from 150 to 157, so we're looking for about a 750 move all the way up to 165. Now you'll note earnings are coming up. So if we sell premium ahead of earnings or even past earnings, if it's going to be past earnings, then it's going to pay us more, but it's paying us more for the risk. And as we're going to this, if you think Johnson & Johnson is pricing in bullishness because it's breaking out today and moving higher, then you're saying, how much risk would I normally take if I tried to own a stock over earnings? If I own a stock over earnings and it gaps, it could gap $2, $3, $5 or more. But if I'm setting this up as a directional trade and I'm looking for 165 and I sell the front week, it's going to be looking at and past earnings. So I'm getting paid higher implied volatility here. If we just sell where we think it's going to go, and again, back to that chart, we said it could go as high as 165, while we're also looking at the deltas near between 30 and 40, I could sell the 160 and collect 120. I could buy 2 weeks later down here, and the total cost of the trade, oops, let me do that again, is 65 cents, maybe 70 cents. So the risk is 65 cents or 70 cents no matter what happens. If it gaps up, gaps down, does not matter, 65 to 70 cents. So the cost here, can you imagine taking and trading over earnings where your max risk is 65 to 70 cents or 65 to $70 per contract? That calendar, if we hit our target after earnings all the way up at 165, that's pricing in a move that is bigger than the expected move, what's the probability of touching it? This is the probability of touching it line, 66% chance that we're going to touch it. Now, if we can touch that and get to expiration, then our front week will expire worthless. We will have paid 70 cents, and our remaining option, if it's at the money then, is worth $3. So we could pay 70 cents, that time decay will go away, and I'm rounding up. We could have paid 70 cents or $70 per contract, and it could be worth $2.90. And if we're looking at that as an opportunity, we'll say 280 because then my math is easier. That is a 4-to-1 reward risk ratio. So if we're talking about 4-to-1, we're going to get paid 4 times as much as we're risking, even if it goes through earnings. And the max you can lose is 70 cents or $70. And you have a probability of touching the target of nearly 65%. This is a high probability trade with a better than expected reward risk ratio, even holding through earnings. And I hope this is making sense. We just want to sell as much implied volatility as we can versus what we're buying. We want to trade to what the technical analysis says the target is going to be tested, or play the probabilities where we can sell what we think won't happen, close past, but will touch. Better than 50% probability of touching, somewhere between a 30 and 40 delta, or selling our target and allowing that calendar to work in our favor. So a 4-to-1 reward risk ratio with a 50 or 60% probability of touching our target really sets us up for a good opportunity even going into earnings. I will continue to talk about this in the main room. Please feel free to reach out to me and ask more questions along this, but we are getting bullish breakouts in financials, consumer discretionary, staples, information technology. Pretty much every sector has a couple of stocks that are breaking out and pointing higher with this rally in the equity market today. Thanks for watching, and join me again next week.